Get ready to level up your financial knowledge today on the Guapify Podcast. On today's episode, I sit down with Kevin Peters, a seasoned financial professional with over 20 years of experience helping people, from professional athletes to everyday investors, just navigate the world of money. So we're breaking down everything from buying and selling stocks to understanding the mutual funds and index funds. Plus, Kevin shares advice on how to afford and choose a financial planner. You don't want to miss this empowering and insightful chat. Kevin Peters, welcome to the Guapify Podcast. We are so excited to have you on. You are truly just an expert and so inspiring. I can't wait to hear more about your career trajectory, investing 101, as told as a Black man who's done it in a space with professional athletes. I definitely want to learn just about investing for someone like myself. I'm not a professional athlete, but I'm sure you'll be able to provide me with tips and tricks that are really actionable and practical for where I am in life. So let's get into it. Tell
Sure.
people a little bit about you. Who are you? What have you done? Like your best elevator pitch, but make it Black.
I'll try to keep it short, sweet, and right to the point. I am, again, Kevin Peters. I am a partner in Equinox Financial Partners. I've been in the business now for financial planning over 30 years. So you can imagine from an investment and insurance perspective, I've seen a lot over the past number of years. I am a part of the Million Dollar Roundtable, which not a lot of advisors are a part of, especially Black financial advisors are part of. I'm very blessed to be able to work with a lot of celebrity clients, whether it be professional athletes or actors and entertainers, but I work with everybody because we all have to start from somewhere. Not a lot of us have that silver spoon in our mouth. And I'm sure I'm going to say it multiple times on this podcast. It's not, how much money you make, it's how much money you keep.
That's really, really profound. How much money you keep.
Mm.
And I think when you talk about keeping money, a big piece of that is investing, right? Like it's not
Mhm.
just having money in a savings account. And while that could be looked at as one form of investing, how do you keep money? And then we'll get into more of how you've supported folks in your spirit keeping money. But like, how do you keep money? What does that look like? Is it investing? And talk to me about what investing is.
So it's actually a two-step process because most of us know how much money we make. We just don't know how much we keep. That's the key, really, right there. So the two-step process I always look at is first step is budgeting. You have to budget yourself out. You have to know what your expenditures are on a monthly basis. Everybody's expenditures are different. Some people have kids, some people don't have kids, whether it's going out for entertainment. There's a lot of things that we can do. The key is budgeting them out. I always tell everybody, I'm not trying to restrict you from what you're doing. Okay. It's just sometimes you don't realize where you're spending money. And it's as simple as this. Sometimes it could be as small as ATM fees. I bank with Bank of America, for example. And the reason why I bank with Bank of America is not because I truly love Bank of America. They just have ATM machines when I travel because I have a problem paying a $5 or $6 fee just to get my own money. And if you really think about that, if you just do that once a week, $5 per week is $260 a year you're spending just getting your own money out. So sometimes it's just about from number one, the budgeting aspect of it. Then the second step is the investment. But first, you have to know about what you're keeping, and that's what the budget's going to help you do.
I love that. So you support your clients with budgeting and investing, whether they're a celebrity client who just signed a multi-million dollar
Mhm.
deal or an average folk who might make six figures, low six figures. Like you start talking about what does your budgeting actually look like and looking for opportunities to even optimize what you have coming in, right? So taking a look at ATM fees or whatever subscriptions that you are signed up to that you don't use. So look at
Okay.
that And then,
Yes.
okay, so let's say we're in a good place. You Dave Ramsey your life, you snowballed, right? Like your zero base budget. You are just you're debt free as much as you possibly can be. But now you're like, I got a little extra money. What should I do with that? Like, where do I even start with investing? What does investing even mean? Like, how would you define investing to the average person who feels like that's a term that goes beyond their tax bracket and understanding?
Great question, because investments to everybody means different things. But the traditional investments are mutual funds, stocks, and bonds. That's your traditional investments. You've heard, I mean, one of the biggest things and questions I get all the time lately is even on cryptocurrency, because we've seen cryptocurrency start to go up. But that's a different type of investments. Real estate is even a different type of investments. But your traditional investments are your stocks, your bonds, and your mutual funds. That's why I always tell people where to start. And there's different levels of those. There's aggressive, there's conservative, there's in between, what we call balance funds. It's There's no one size that fits all, and sometimes you always hear, oh, you got to be aggressive to make money. That's not true. That's not true at all. It's about what your time frame is, number one, what you're comfortable with doing, number two. All right. And also, what are you going to be using it for is also number three. Because sometimes you really have to factor all that into it to come down to a nice decision.
Okay, so we got stocks, bonds, mutual funds.
Mhm.
What does that look like? If you were just going to break down the
Sure.
stock, assuming it's the stock market, I'm like mutual funds, bonds, like,
Sure.
yes, tell me
I,
exactly what.
I'm going to give you nice, easy examples of all. So most of us have heard of a stock before, and nowadays you don't really see stock certificates, but a stock certificate is the exact same size as a loose leaf piece of paper. It's the exact same thing. You can One of the stocks I like to use is like Apple or Nike, because most of my clients will have some type of Apple product, iPod or iPad or something of that nature. And I use Nike because everybody who knows me knows I'm a Nike freak. I love wearing Nike. Anything with a swoosh on, I have to have, no matter what. So one share of Nike stock is almost $100 a share. Okay. You do own the company. That's the greatest thing about it. Now, it's only one share. There's what we call millions of outstanding shares. So if you own one share and there's 100 million outstanding shares, you're a fractional owner in that company. All right. And the reason why I say it this way is because you do own a piece of Nike in that example, but you can't really go to your Nike outlet and start grabbing stuff off the shelves because you own the company now. You
Right.
can't do that, but you do own the company. So if Nike's trading at $100 a share, it goes to 101, you're happy. It goes to 99, you're not. That's all a stock is ownership in a company.
Ownership in a company, and there are many owners. So you have a little
Correct.
piece of the pie, but you could get more of the pie depending on how much money you have to invest, right? So like,
Correct. Right.
okay,
Because you could buy two shares, three shares. So you can buy more and more shares. But I just use the one share as an example because that way it's easy to go from 100 to 101 or 99, and you can kind of know whether I made money or I did not make any money.
okay, so that makes sense. So for stocks and then mutual bonds, and there was index funds or index funds
Yep.
and bonds.
Yep. But hold on. Before we go to that, I'm going to go to mutual funds because that
Cool.
way from stocks to mutual funds, so what a mutual fund is, and I always relate it to this, most of us have gone to malls before. And one of the reasons why we like going to a mall is for the convenience to shop. You can go to one place to access, let's say, 100 different stores. That's a mutual fund.
Oh, I love that. That makes
That
perfect sense. There's Forever
that
21, there's Apple, there's Louis Vuitton. So like, but you're in one location. You just move around. Yeah.
correct. And one word, a lot of us have heard associated with mutual funds, is actually diversification.
Yes. Diversification.
And that's what a mutual fund does. It allows you to go to one place to be diversified in many different companies, just like you go to your local mall.
Is that more of a conservative approach rather than investing in one particular company like Apple? You're putting all your money in Apple versus a mutual fund where you have this diversification and you are technically putting a little bit of money in each of these companies. Would you consider that conservative? Or is there opportunity to be more conservative or more aggressive within the type of stock or investment that you choose?
The great thing with mutual funds, there's many different types of mutual funds. So you can go into an aggressive mutual fund, or you can go to a conservative mutual fund, or one right in between. So it really all depends on which mutual fund we're talking about.
And what does that mean, aggressive versus conservative? Like, I know what those words mean, but in the context of investing, what would that look like? Specifically, if you were looking at a mutual fund that was more aggressive versus conservative, how would you just bite size explain that?
Sure. The more aggressive a fund is, or more aggressive a stock is, it's designed to get you the biggest bang for your buck as quick as possible. Think of it like you have multiple cars, and if I got a Ferrari, it's designed for me to go fast. That's exactly what aggressive nature means. They're trying to get you your biggest bang for your buck in the shortest period of time. And then obviously, conservative would be on the opposite side. It's meant to be more of the slow, steady type of thing. Is one better than the other? You can't say it. It all depends on how you feel.
Okay, so for your clients that you have supported, and a lot of them have been professional athletes and celebrities, have you
Mhm.
seen them do more aggressive investments or conservative? I'm curious what the wealthy's doing.
That's actually a really good question, because if I had to lean towards one, most of the clients are going to be more towards on the aggressive side. They actually tend to see, but remember, being more aggressive, you're going to have more volatility in your balance in your accounts too, because it's designed to keep going as fast as possible. But again, like I said, it's just because you're aggressive doesn't mean you're going to have more of a return. It really truly all depends. The quickest thing and the best thing I can say is the length of time it has to grow.
Okay,
That is the key.
length of time, which feels a little more conservative. So I have a follow-up question about the length of time, but
Mhm.
did we talk about index? I know we talked
Sure.
about. Mhm.
Yep. Yep. So what an index fund, all right, and all it means is most of us have heard of the S&P 500, and it stands for Standard and Poor's 500. And what it does is, the great thing about the name, it says exactly what it does. It's 500 stocks. And all they do is they put 500 stocks, and it makes up an index. So imagine putting 500 stocks in a circle, and that circle represents the S&P. So if I want to go into the S&P, I can buy into the S&P, but by a fraction percentage of each one of those 500 companies. So it's called an index mutual fund. That's all it is.
That was really easy to understand. I think a lot of these terms can sound so robust, but when you break it down, it's all the same sort of infrastructure. They just kind of like sit in different categories, and you have to kind of identify where you want to go. So how does someone get support identifying where they should invest? If it was me and I'm like, okay, Kevin, I have $5,000, right? And I want to invest it. I want to earn money on my money. I want to keep my money, like we've been talking about. Where do I start? Are we going to just take a holistic look at what I need in my life? Or if I said, hey, I don't need the money quickly, I'm comfortable with letting it sit. I don't have a preferred company I want to invest in, but I would just like to have some money made on it in the next 5 years. How would you advise me?
I would advise you, but and I think you kind of started off perfectly where I would have started, is knowing more about what your goals are, because that's the key. Is your goal could be, all right, I want to put this money away for a vacation in 12 months, or buy a house in the next 3 or 4 years, or put this more towards your retirement. Three different terminologies there and three different goals. So sometimes we might actually have investment buckets for different purposes, just to help you get to those goals. So and to your example you gave before, what I would say is, okay, you know what we need to do is take a step or two back and get those buckets filled. So how are we going to get to those buckets? The shorter the time frame, I'm going to be looking more towards conservative investments. The longer the time frame, I'm going to be looking to maybe a little bit more towards moderate to aggressive things, because we can. But your overall portfolio, though, can be balanced. And that's what we want to do, is make sure that you're somewhat balanced, because the market is a big cyclical cycle. Whatever goes up today becomes overvalued, and then the undervalued becomes valued. It's like a big circle. The key is you got to figure out what end of the circle you want to be on. And that's what I help you with, is making sure that we're in those right circles, part of that circle.
Okay, that's helpful. So it really is specific to each person's goal, how much money they have to work with, if
Mhm.
they're willing to give it some time. I know there's this term called short-term capital gains and long-term capital gains. That sounds like it's connected with being conservative, with waiting. Do you mind breaking down what that looks like? Because there's this piece of investing that I think can cause nerves, and it's taxes, right? Owing Uncle Sam if you don't know what
Yes.
you're doing. So if you could break down short-term capital gains and long-term capital gains.
Absolutely. So whenever we make interest earned on any money, IRS wants a piece of that. All right. Unfortunately, there has to be taxes due. So IRS will break it down into two categories: short-term capital gains and long-term capital gains. So short-term capital gains is anything that's 13 months or less. So I'm going to give you an example. We buy Apple stock today, and then we sell it 8 months from now. That's underneath the 13 months. That would be considered short-term capital gains, which means now you're taxed at a higher tax bracket.
Okay.
Long-term capital gains are 13 months and longer, which means now that's if we waited to sell, let's say Apple stock, and we did it a year and a half from now, it would be considered long-term capital gains. And then your tax structure could be 15% versus 20 or higher percent.
So you pay less taxes on the money that you let sit for a longer amount of
That
time.
is exactly correct. So, but the 13-month is the barrier where IRS will look to see how it's determined whether it's considered short-term or long-term capital gains.
That's very helpful. So for those who are feeling a little weary around short-term and long-term capital gains, it's pretty black and white. If you can let your money sit, you can pay less taxes on that, which means more money in your pocket. So
Yes, and you could it could be significant amount too, because you're looking at long-term capital gains being at 15%, and depending on what the other investment is, you could be looking at north of 20%. So that 5, 10, 15% difference could make a big difference in your pocket at the end of the day.
I'm curious, you just having a wealth of knowledge and a history with investing, do you have any personal story of making an incredible investment and really seeing a lovely return, or advising someone that you were supporting with making an investment and it really just being something profound that they experienced that was life changing? I mean, it doesn't have to be, millions, but something that really made it's like, wow, this was great advice. This was great consulting. Like this really worked for me. So it could be in your personal life or someone that you supported.
I'll even tell you more about personal, especially when I first got into this business. Because, when I first got into this business, things, it was almost like I was related to like a whole different world. All this information was thrown. I mean, I thought, oh, all right, I can still do this. So a short story is I ended up buying a stock that appreciated really quickly in a very short period of time. And I made a very, very nice chunk of change in a very short period of time. And it's kind of like the old saying when you go to Las Vegas or Atlantic City, when you win, the first time, you're like, oh, this is easy, you know, and
Absolutely. I'll do it
you
again.
know, and, yeah, I can just do it again. I can just go ahead and do it again. And it didn't work out the second time when I did it. And I started to have a more of a sense, and I kind of also related to clients now is you don't chase returns. That's the one thing that gets people in trouble is chasing returns. When something happens this way, I notice there's never a blueprint with investments. Things change all the time. Economic conditions change. So what seems very similar could be really different on the underlying measures. So I think that happening to me early on in my career actually helps me advise clients completely different because you can't chase these returns. You have to look at things individually and make decisions at that time. You can't make some, oh, I won this before. I can do this again. You can't do it that way.
I think that is really helpful. So that was kind of personal development for you, right? Like you experienced something where it was like, this feels great. Let's give it a go. And then you realize, wait a second, this may not happen every single time. And if you're only chased by the high of that return coming in, I'm sure you can find yourself in a place where that's the only thing you're focused on. What should be the focus then? What should be the focus ideally when you are investing? Is it just the opportunity to keep your money and earn interest on your money or make a return on your money that will essentially create generational wealth? Like what, even if it's your personal opinion, like what would you say?
So I think one of the biggest things I try to tell everybody is don't look so much on the upside. Okay. Because what I do is when I design portfolios, it's about the risk that you're going for that upside. All right. So I'll give you a prime example. If I have two separate portfolios and they both earn 10% return this year, first portfolio took 100% of the risk to get that 10%, but the other portfolio took 50% of the risk to get that same 10%. That's the difference. So portfolio B is actually better than portfolio A because you took half the risk to get the exact same return. A lot of people don't see it that way. Everybody's looking at, okay, what is the return I get? What is the return I get? I'm like, well, sometimes let's see what that risk you took to get that. And I also related back to like a Las Vegas or Atlantic City. You wouldn't go to the blackjack table to put $50 down and risk $50 to win $1. That makes no sense. But
Right.
risking $1 to make $50, that's different now. Hence, that's the portfolio B that I was mentioning, because you took a lot less risk to get the exact same return.
Answered my question because I was gonna be like, what does the 100% risk look like? If that makes total sense. And having a financial advisor is really critical to provide that language and insight so that you do understand what is the right portfolio for me to pick. Because would you agree that even for the person who's quite read and really financially literate, they still might feel a little lost when it comes to selecting the right investments or just understanding like what is my return on investment going to look like? Like when is the best time to sell? Even figuring out when to sell, there seems like there's a science to it. And I know there are day traders and people who like do this really well, but
Mhm,
for those who have stocks that have been sitting, right,
mhm.
conservatively, they're earning their interest on it and all the beautiful things that happen. Well, how do you know when to actually sell? Like who advises you on that? And like when you sell, is there someone who walks you through like the actual action items, like the steps to sell? Like, can you just quickly break that down, what that looks like? Because it feels like such a mystery.
It is, and there is no true science because there's different times and different measures for different things. But if I had to give you an overall answer, the best thing I can give you is I try to look at what the valuation is of that individual investment and see is there more upside versus downside risk to that. So if we're buying Nike stock, all right, and it's trading at $100, but I feel that the valuation of it is 110, then there's still a 10% upside to that Nike stock. But if I do see that there's some downside risk to it, but the downside risk is only, let's say, 5%, well, then it still makes sense to keep it because you have more upside potential than that downside risk. If it was flip-flopped, then my thing would be like, let's take our profits and go because I see more downside risk. So if I had to summarize it, I would just try to say, if I see more upside potential, I keep it. If I see more downside risk, I do not.
Okay, that's helpful. So figuring out the right risk. All right. So the federal interest rate, I've been seeing like everywhere. The Fed's cutting rates, they're cutting rates. And I'm just like, cool, what does that mean? Like, how does that affect me? Does it impact me? Can you just give me a little insight? Like what is happening when they're
Sure.
cutting?
How it affects us. That's the bottom line. At the end of the day, when we cut interest rates, it affects us really by loans and like whether it be mortgage rates, personal loans. The most impactful one that affects everybody is credit card rates. It goes by that as well. So it does give you a little bit of a breather. So when they cut interest rates, most of the time you'll see that cut interest rates by a quarter point or sometimes a half a point. You'll see you'll notice that now if you're making payments on your credit cards, that minimum payment now goes less because you're being charged less of an interest rate on that. So that's how it affects us.
Okay, that's helpful. So that minimum, even though you should be paying your statement balance, but if you are paying
Correct.
the minimum balance, it'll be less than what it looked like some months before because the interest rate has gone down.
That is correct. That is correct.
Okay, so now we know how that kind of impacts us. Now, just when it comes to keeping your money, investing your money, how do you make sure the money doesn't run out? Like, what are some ways to actually safeguard your money so you can continue to invest? Like, let's say you want to go all in. You made 5,000, now you got 5,000 to play with. Like, how do we make sure that you still keep money in savings? Is it just you guide me? If I'm sitting in front of you, like I got 5,000, what do I do?
Well, to me, there'd be two things. One, I would go full circle back to the length of time, because that is going to be the key for everything, is the length of time it has to grow. The second thing is also, all right, well, what is the purpose of this? All right, because sometimes there's no reason to be overly aggressive. Or sometimes, by the way, I've taught clients from being too conservative at the same time. And it's sometimes when I say too conservative, sometimes people are like, how can you be too conservative on anything? Well, think of it this way right now. Inflation happens to be one of the biggest concerns that's going on for everybody right now.
Yeah.
And what inflation is basically the cost of goods over time. That's really what inflation is. So we've seen it since COVID, because COVID really changed the game for everybody. And if there's less of a supply for something, basically they can charge more for it because there's more of a demand for it. The problem is we didn't have a lot of supply. We had a lot of demand during COVID. It shot prices up dramatically, and prices have basically stayed high since then. So what the government tries to do is raise interest rates in order to combat that. When you raise interest rates, it slows people from spending, because guess what? You're spending more now for that. So
Wow.
yep,
That's wild. So it's an intentional effort to
correct.
politely request for folks to stop buying this so much
Correct.
and not so politely because it's like you're going to feel it in your pocket. So one week strawberries might be 3.99, but next week it could be 10.99 because the supply and demand. And
That
so
is it. That is exactly correct. Even a personal story I tell all the time is I try to work out. I go to the gym 5 days a week. I eat these kind protein bars. Pre-COVID, they were a box. I think I was getting like six in a box. It was 2.99. They're 6.19 now. So you're talking about basically tripling in a 4 year period of time for the exact same thing. So instead of buying two or three boxes like I used to, now I'm basically buying one box. See, so it slows the consumer from spending money. Then, as you use your credit cards, because the interest rate was high, that minimum payment now is up here now. So now it slows you from maybe spending the same amount of money, and it slows the economy down. That's why they raise interest rates, and that's why they cut interest rates to do the opposite effect.
okay, so a part of making sure your money doesn't run out is also being frugal when you need to be, knowing when to scale back, knowing when to
Correct.
pull back, and really being aware of what's happening at a global level, at a national level, at a local level, like however it's going to impact you, so you figure out what you can spend and when you need to pull back. So that's a part of being conservative, it sounds like.
That's exactly correct. So we have to make sure in terms of, okay, so you don't run out of money. Well, how much money do you think you're going to need versus how much are we saving today? Let's plan out to make sure that that money does not run out. I can calculate, basically as a rule of thumb, we try to say you want to stay ahead of inflation. Inflation right now is about hovering around 3%. So that's what I was saying before about being too conservative, because a lot of us will put money in a savings account, and savings accounts will give you less than 3%. So you're not even keeping pace with the cost of goods out there. So you're actually going backwards by doing it that way. So,
Okay. Yep. So there's that balance to it. And when I look at my 401k projection,
mhm,
through my company, they'll sort of highlight this is how much money we think you'll need in 30
mhm,
years. Inflation is
mhm.
usually like one of those notes. Like if,
Yes,
the cost of supply and demand increases, like you should think about maybe putting this much away to anticipate it. So it sounds like having a plan and imagining what factors might be at play really makes a difference when it comes to ensuring you keep your money in your pocket long term.
absolutely. And I'm glad you mentioned 401k, because I think that's one of the best ways, as what I say is a forced savings that we can do as people. Because unfortunately, we're into what can we buy today society. It's like, what can I have today? And sometimes that forced savings is one of the best ways to do it because when a 401k, it takes it from your paycheck almost before you get it. So it helps out from a saving perspective in the long run.
Awesome. So those pre-tax dollars that go away will benefit you on the back end when it's time to
Absolutely.
retire or wrap up whatever kind of work you're doing before you move into entrepreneurship or just good old retirement. And
Yep.
speaking of entrepreneurship and, just being like a consultant and
Mhm.
advisor, which I am gonna call you all those things as well.
Mhm.
How do you get paid? How do financial advisors get paid? Someone who's doing work like yourself and maybe is retained as a consultant or advisor, like is it just people writing a check to you or like what does that look like to actually hire a financial advisor?
Great. There are two ways financial advisors get paid. One, I'm a fiduciary, which simply means I have to act in the client's best interest. So what I'll do is I will charge you an annual fee to manage your portfolio. That annual fee, an average fee is about between 1 to 1.25% per year that is charged on a quarterly basis. So if I say 1%, every quarter it's 0.25% that comes out. So it's very simple. It automatically comes out of the account. It's on the last quarter of the month. And the great thing about it is it's on the balance of your portfolio. So the more money that's in your portfolio, the more I make at the same time. So we both have skin in the game.
Oh, nice. So if it's like 100,000, you just do the percentage of that and you're getting a piece of whatever that money is being built up to, right?
That is exactly correct. So that way, I'm always acting in your best interest because obviously the more money I make for you, the more I make it for myself too. So we both have skin in the game in that.
Oh, that's pretty nice. It sounds like the money just keeps coming in. Okay.
Absolutely. And the great thing about having a fiduciary responsibility, because again, I have to act in your best interest. So we are constantly talking, minimum usually once or twice a month, and I'm always updating you on what your portfolio is either doing, not doing, some changes that have to be made in the portfolio, so on and so forth.
Okay, so how does someone find a financial advisor? Like the average person, not a celebrity, not
Mhm.
a professional athlete, just, average working person. Where would they start?
Well, the great thing about it is there are two ways. One, easiest one is obviously referrals. If somebody is already using a financial advisor, that's the best way because you can get great information from your friends. Putting that aside, I always recommend going to some of the larger houses, whether it be the Fidelities, the Merrill Lynches, the Charles Schwabs, things of that nature, because it's a large brokerage house. They have very reputable names to them. And that way, you can also go on what they call broker check. Broker check. So if you do find a financial advisor, you can put the name in broker check and you can almost do a background check on that advisor as well. So it helps you to get background information on somebody to make sure they're legit too.
Oh, that's dope. Broker check. That's the site to check out.
That's exactly correct. Brokercheck.com.
Okay, amazing. So I will actually be using that. I'll add that to my New Year's resolution as I continue to improve my financial health and my financial literacy. A quick question about Travis Hunter. Are you familiar
Mhm.
with Travis Hunter? So Travis Hunter, 21 years old, Colorado Buffaloes football team, about to come into a lot of money. What do you think he should be doing right now, thinking about to prepare for the income flow that he's going to see come his way?
Generally, with my athlete clients, especially from the stature of a Travis Hunter, you'll hear things like prenup. I can't force clients to do prenups. I can only mention it to them. So I do recommend having some type of prenup in place. Then we always talk about between the wills and trusts. A will is one of the simplest things that us as people can do. It doesn't matter how much money you have or you don't have, because what happens is that it doesn't make a difference what state you're in. If something happens to you and God forbid you pass away, right now, no one knows who gets what. You can't do it verbally. It has to be written down. If not, the state will tell you who gets what. And let's call it like it is. The state doesn't know your best friend. The state doesn't know your wife. The state doesn't know your cousins. And generally speaking, it's not going to go the way that you want. So a will, I always recommend. Then I'll go into the budgeting aspect of it because you're going to be coming into a lot of money in a very short period of time. Especially football, the average lifespan of a football player is less than 3 years. So while Travis is 21 years old, he theoretically, and I say this in air quotes, could be retired but by the time he gets to be 24 years old. So I'm very huge on budgeting things out and planning for later on in life. A lot of my athlete clients will go into coaching, for example, or sometimes going back to school to finish their degrees is another thing. You got to have cash for that. So I will make sure money's put aside for those particular things beyond just the natural of income coming in and natural expenses. So those are the things I would be recommending to Travis.
I love that. I think that is sustainable. And I feel like not only Travis, but someone like myself and all my peers need that same kind of guidance because there are a lot of things that come up that go beyond the next 3 years. But that's really interesting that the average span for a football player could only be 3 years. Like to think that by 24, you could be retired. You would hate for him to have blown through all his money and be like, okay, I got to go work at my local Trader Joe's. So the goal is to
Yep.
avoid that, right?
Yeah, and what happens, especially with football players, and most people don't realize that their football players' contracts are not guaranteed. The only guaranteed portion of your contract is basically your bonus. So the league minimum this year is about $800,000, which is paid over 18 weeks, which is call it 4 months. The other 8 months you're not getting paid. So you have to budget out those things. You
Wow. So if
know,
you fall out in those 4 months, like you could be broke.
you
If
could
you
be broke the other eight.
right. Okay. So that sounds like you need a financial advisor like yourself to make sure you have your money flowing in for the 12 months of the year.
Exactly. And then of course you have the IRS aspects of it and stuff like that. So I kind of recommend about trying to reduce some of the taxable liabilities that can come in because IRS will go after single high wealthy individuals first. They look at those people first. So he's going to be in a very high tax bracket. So I kind of will recommend things to try to lower that tax bracket because it's either one of two things. Either you're going to give it to Uncle Sam or you're going to give it to yourself. And I'm like, I'm pretty sure I can answer the question that you rather give it to yourself.
Bet on yourself every time. Absolutely. Kevin, thank you so much. This was really insightful. I am just in
Thank
awe
you.
like your level of wisdom and
Thank you.
literacy. And I can't wait to find myself on your calendar for my so I
I
can
look forward to it.
solid. So here in Guapify, we have a rapid questions. Just after we get into all the good stuff, we like to ask you a few fun questions just to hear what your answer might be, learn a little bit about you. So I have 3 to 4, looking at time. All right. So first one up, what's a money habit you swear by?
I would probably say the best money habit I swear by is not how much money you make, how much money you keep. That's my habit. That is my habit because we focus too much on how much money we make. And I've seen people make high incomes that have nothing, and people who don't make high incomes have a lot. So we can focus on how much money we keep. That's the model you should be focused on.
I love that. That's about to be my motto too. Like, okay, first thing you do if you won the lottery. I believe right now the lottery is something crazy like 800 million. We're in December. Like, so if you were someone who won, what would be the first thing that you do?
Since we're talking about north of $800 million, which is a lot of money, there are two things I would do. One is I look at generational wealth. Because you can take money and have that money make money for you. So whether it be like real estate, whereas you can buy properties where that generates income from you off of that. So to me, I would be looking from that aspect. The second thing, as we were talking about professional sports, since I have a lot of celebrity clients, a lot of people in the NFL, over 70% of the NFL athletes are African American. All right. And that's a statistic that I see every single day. And with that type of money, I would love to purchase a team and be a minority owner because we need to be have more representation in professional sports since we represent more than 70% of that. So I would love to purchase an NFL team and be a minority owner and bring more of us into that fold.
I love that. I was not expecting the inspirational, aspirational answer. I thought you were like, oh, I'm going to go buy a Lambo. That's amazing. So we got to make sure we either help you in the lottery or get you an angel investor.
Thank you.
Okay, so last one. How do you unwind after a stressful financial conversation?
There are many, many days, but the one thing I try to make sure for myself is to take care of my health. And I go to the gym 5 times a week. So it allows me to release that stress from the financial day. And I recommend it to everybody because one of the worst stresses to have is financial stress, that's in there because that'll weigh on you beyond anything. So it allows me to go to the gym, and that's me. It could be many different things for everybody else, but I will go to the gym. I don't have my phone on me at all. That hour is my time. I will be able to work the weights and I can, all that aggression I got from all the day, I can just get it out and it makes me feel so much better by the time I leave. So that's how I unwind.
I love that. Health and wealth just combined together. That's amazing. And Kevin, you made a really great point around financial stress and it being a really heavy and weighty one. Can you talk about that a little bit more?
Absolutely. Financial stress for a lot of people, and I hate to even say it this way, it gets exacerbated because it's something that we don't want to admit. It's something that we keep inside. And like prime example is you can go out and buy a brand new car. It doesn't make a difference how much money it is. It's in your driveway. It should be in your driveway. When people drive by, it's like, oh, okay, Kevin's doing well. But when you walk in this house, it could be completely different. But I have to keep this facade up that I'm doing well. So sometimes all you're doing is really putting more gasoline on the fire because you're not admitting that I actually can't afford this, and then I will buy something else to make sure people on the outside see something. So financial stress it's a real thing. I try to help people mitigate that by one, as long as they can admit that there's a problem. That's number one. Number two is the budgeting aspect. Again, I can't begin to tell you how the budgeting helps so much because if you can budget things out, then we can start to budget. Okay, how can we pay the debt down or pay that debt off? Once that debt is, and I kind of go back to my analogy about going to the gym, that debt is a weight. And sometimes that weight is so heavy. But if we can start to chip away at that, whether it be 12 months from now or 13 or 14 months from now, that weight gets lighter to the point it's not even there anymore. Then you can start to breathe again. So it's a real thing. And hopefully people will start to understand that they can admit the problem and then we can help solve it.
Absolutely. I do believe that like saying it out loud makes a difference because it breaks the shame and the stigma because most people are challenged somewhere with finances. And so talking about it and saying I need help really is a great first step. And you mentioned debt, and debt is crushing and it feels impossible. But talking to someone like you make it feel possible to create a plan to get out of it. And I think that's half the battle. When you're struggling in silence about debt that seems just surmounting and it feels like you have no idea where to begin, having support through someone who's financially literate really does make a difference. And that requires saying that you need help. So for anyone listening and you feel some shame or you feel like you're not where you're supposed to be, most people feel that way anyway, but like opening up your mouth and saying I'm struggling financially is probably the best place to start, and then getting the right support to come up with a plan to get out of it because it's possible.
Absolutely correct.